City, I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief.
Good morning, everyone. Stock futures are near the flat line ahead of a busy week that includes a number of retail earnings reports and the Democratic National Convention kicking off. Plus, Wall Street tracking the next test for the markets, the Fed's annual Economic Symposium, where we'll get more hints about the path of monetary policy and that critical first rate cut. So let's get into it. The three things you need to know to start your trading day. Yahoo Finance's Jared Blickry, Madison Mills, and Rick Newman have more.
Thank you. Stock futures are near the flat line after the S&P 500 clocked its best week of the year last week. The Nasdaq and Dow also saw winning streaks amid what has been a volatile August. Now investors are looking to the Fed's annual Economic Symposium in Jackson Hole, Wyoming. The vast majority of traders currently pricing in a 25 basis point rate cut in September, according to the CME FedWatch tool. Around 25% of traders are in the 50 basis point camp. Now, the depth of that first rate cut and Powell's tone around the trajectory of monetary policy will be in focus as fears of a recession ease and Wall Street prices in a soft landing.
And we've got more insight into the health of the consumer this week with reports out from Lowe's, Target, Macy's, TJ Maxx, and BJ's. Now, all of this comes after retail sales rose 1% in July. That was more than anticipated, easing investor fears of an economic slowdown. Walmart earnings also fueled positive sentiment as the business did prove resilient against discerning consumers and sticky inflation. This week's upcoming reports could help clarify this earnings cycle's mixed picture on consumer spending.
And the Democratic National Convention kicks off tonight in Chicago with a big speech by President Biden. He'll be passing the so-called baton to Vice President Kamala Harris, who's already been officially designated the party's nominee. So the conference will focus on speeches and finalizing the party's platform. Harris released parts of an economic plan late last week. We can expect to hear from First Lady Jill Biden, former President Barack Obama, Second Gentleman Doug Emhoff, former President Bill Clinton, and of course, Harris's running mate, Minnesota Governor Tim Walz. Vice President Harris will take the stage Thursday night to wrap the conference.
It's Monday, August 19th. Let's get to your investor checklist for the trading week here. The number one thing to watch this week, we've got Fed Chair Powell's speech out of Jackson Hole. That's coming Friday morning. Now, investors, they're going to be paying close attention to Powell's words and his tone. Will hints of a rate cut spark a rally here? And of course, at previous Jackson Hole symposiums, I mean, we've come a long way from just the 8-minute address of 2 years ago, and now much more focus on what the depth and pathway for these rate cuts coming forward could look like.
Yeah, Brad, I think a big question here for the markets, and you talked about whether or not it's going to trigger a rally. A lot of that is going to be based on exactly what we hear from Powell and maybe the willingness of not only 25 basis points at the next meeting in September, whether or not he even leaves 50 basis points on the table. And as we start the show this morning, just over 70% of traders now pricing in the odds of a 25 basis point cut in September. That's compared to less than 30% that are expecting that 50 basis point cut in September. But again, any sort of signaling in terms of some of that dovish commentary could likely drive some of that market momentum here to the upside. We also want to take a close look at here, keep on our radar, a slew of retail earnings that we're going to get here this week. It's going to offer another glimpse at the strength of the U.S. consumer, whether or not actually we're seeing some weakness. We want to keep a close eye on Target specifically for signs of weakness in discretionary spending. That has certainly been a trend for their earnings reports here over the last several quarters, and they're far from the only retailer that's reporting this week. We're also going to hear from TJX. We also got Lowe's, a number of the names up here on your screen. We've got Macy's coming out on Wednesday. So again, just getting us a better insight here to the consumer and exactly some of the trends that we are seeing, because yes, Walmart did look strong when you take a look at those headline numbers, but underneath the hood, though, there was certainly reason to believe that there is a cautious consumer right now who is pulling back on spending.
Yeah, in our conversation with John David Rainey last week, the CFO over at Walmart, he definitely talked about what they're seeing in the signs of the consumer, not necessarily weak, but not the most strong right now. And so I think that's where they're going to continue to lean into the trade-in verbiage that we've heard Walmart talk about. It's interesting, for all of these household known names, the largest retailer that's actually reporting this week is Lowe's. So we'll get that one tomorrow here. I didn't even know that by market cap, Lowe's is almost double the size of Target. So we'll be keeping a close eye on that one. But of course, Target and the bullseye going to be in focus. Macy's, about $5-6 billion market cap company there. That's going to be in focus as well. Plus some of the discount retailers, as they call them, in TJX and Ross. Also, finally, the Democratic National Convention kicking off in Chicago, Chi-Town today. President Joe Biden going to headline tonight, and the big thing for investors to watch this week, details of Vice President Harris's economic agenda. One of the major things that we've seen already be released is the economic plan, looking at some of the cuts for households, where there could be credits coming forward for additional child, and then additionally for some of those new-time home buyers. We were discussing that last week on Wealth as well.
Yeah, I think investors in Wall Street really looking for a little bit more in terms of the details of what we got from the outline here of Vice President Harris's economic agenda, maybe more specifically what it would look like under a Harris administration. And then I think we're going to see more comparisons, right? Lots of questions or lots of fear surrounding some of the rhetoric, some of the commentary that we've heard from former President Donald Trump, what tariffs, what his plans there, what exactly that could ultimately do for the Fed's fight to tame inflation, and how that would potentially complicate some of those efforts. So I think more comparisons there, and exactly what this means for the economy going forward is certainly going to be a focus here this week. Let's zero in on Jackson Hole and what investors need to hear from Fed Chair Jay Powell in his speech on Friday. We want to bring in Satyam Pandey. He is the chief economist of the U.S. and Canada at S&P Global Ratings. We're also joined by Eric Bailey, executive managing director of wealth management at Steward Partners Global Advisory. Great to have both of you. Satyam, let me start with you here. When we're trying to figure out what exactly we're going to hear from Fed Chair Jay Powell, how much is riding on the speech we're going to get on Friday, and just in terms of what likely then that ultimately means for the path forward here for the Fed?
Well, the speech on Friday, I think Jay Powell is not going to really show exactly what they're going to do in September, although he may lean towards being more dovish than not. But we do expect some kind of a signal coming in from either him or other Fed central bankers in their interviews that they may be ready to cut a 25 basis point rate cut for September. There won't be much said about the next few cuts. I think they will be very data dependent oriented in their communications. And I think they should be like that. Otherwise, I think more broadly, it would be nice to get a window into how they are seeing the transmission of monetary policy during easing cycle sort of pan out, right? An easing cycle would be different from an hiking cycle. So we would like to see how their reaction function changes.
Eric, what would you be watching for? What is your keyword alert that you have set up going into this symposium this week?
Yeah, I think the markets are certainly expecting language that's going to show the Fed is dovish, as Satyam said, and that, as you guys said, they're expecting, 75% are expecting a 25 basis cut. So we don't want any surprises. I mean, the markets have had a very strong comeback from that August 5th sell-off. And we've seen economic numbers, both the CPI and job numbers, that have encouraged and given confidence to the markets. And we've seen that, right? The S&P is now back up over 17% year to date, only 2% from the highs. And we've seen very positive reaction from, a slew of different corporate earnings. So I think, Jackson Hole, the key is kind of to go with what the data has said and showing that an easing cycle is coming, whether it's September or very soon.
Eric, so what if we don't get any hints of a rate cut? What does that ultimately mean then for the market? Could we see a big sell-off on that?
Yeah, I think a surprise would trigger volatility and a sell-off. Certainly, I think, the risk trade has come back on. So I think you would see investors get more nervous and sell off the riskier parts of the market, go more conservative, because rate cuts are expected. And so if that doesn't happen, I expect volatility would certainly heighten.
I mean, what's the likelihood, Satyam, from your perspective, that we would still get some piece of data that upsets the Fed enough or gives them enough reason to say that we don't need to cut at this juncture? Because as of right now, their next meeting is going to be mid-September, the 17th and 18th. Prior to that, we still do have a whole week of employment data that we're going to be getting in early September as well here. So is there anything within the labor market that the Fed could look back to and say, well, it seems like we've got strength there still, so ultimately we don't need to do anything right now?
You know, a lot of the data that has come out since the last meeting has been more on the side of cutting than not. And one more month of employment data that's going to come out between now and the September meeting is probably not going to change their minds unless there are major revisions upside. Upward revisions would do that, but we don't expect that at all. In fact, we are expecting some backward-looking downward revisions to payroll data. So there's a very high bar for them to think that they may need to hold or not cut at this moment in September.
And Sati, I'm just taking the other side of that. What is going to prompt them then to cut by 50 basis points? Is it going to be another weak jobs report similar to the one that we got 2 weeks ago?
Yes, it would have to be materially weak jobs report compared to the last 3 months average. And you know, the other high frequency data don't show that, but you never know. If we get that in the first week of September, there is a chance that they may go with a 50 basis point rate cut. Okay,
and so Eric, just putting the wealth management hat on now, what does that kind of pertail for or hold for some of the investment strategy? What is the trade going into that next major Fed meeting that investors should be considering if they're not already kind of diversified in the way that many analysts have and, well, many strategists have been telling us to be?
Yeah, well, you know, in the short term, clearly, I think you'd probably be a little cautious. You'd probably want to wait and react to what they say, because if they surprise and don't give language that shows they're easing, you could see a sell-off. And so in the short term, I'd probably be, I would be on the side of caution. But long term, I think equities, growth equities, clearly is the very strong trend we've seen now for a while in the markets. I would stick that course. I'd stick with long-term growth investments, because if we do get an easing cycle, which I expect, that area of the markets is going to continue to benefit.
Satyam Pandey, who is the chief U.S. and Canada economist over at S&P Global Ratings, and Eric Bailey, who is the executive managing director of wealth management at Steward Partners Global Advisory. Thank you both for joining us here this morning before the market open. Appreciate it.
Thank you.
The Democratic National Convention kicking off today in Chicago, and it'll run through Thursday. Today's agenda includes a breakfast, plenty of caucus meetings, and council meetings, culminating in a big speech from President Biden this evening. Less than 80 days out from the election, we're seeing Vice President Harris with a small lead over former President Trump in national polls. Here with more on what we can expect from the DNC, we have Yahoo Finance senior columnist Rick Newman. Rick, all right, what should we be listening for over the course of this week, and what's the potential kind of climax moment that could happen?
That's a great question. And in terms of that climax moment, I think what a lot of political analysts are wondering is, I mean, there's typically this thing called the convention bounce because you get all this primetime coverage. Usually you go up in the polls by a couple of points after the convention. It's possible that given that Kamala Harris has come up in the polls so much already, and you just showed that in many polls she's now leading Donald Trump, some people think maybe the convention bounce has already happened. So I think what a lot of seasoned political watchers are wondering is, where does she top out? And is it possible that she's sort of at the peak right now, given that she's been in this so-called honeymoon period? A couple other things I'm watching for. I mean, if you're really entertained by political speeches, you know, tune in and find out what the Democrats have to say about how they're differentiating themselves from Donald Trump this time around. One big thing to keep an eye on is these protests over the Israeli war in Gaza. I think the question is, do these become intense enough that they sort of overtake what's happening at the convention and become a bigger part of the news than what's actually happening there? My guess is no. I don't think they're going to be that intense. One of the reasons is a lot of the protests from last year, they happen on college campuses, and this is not a college campus. Plus, colleges are not in session for the most part right now. So there's that. And then you've got this very interesting juxtaposition between Joe Biden and Kamala Harris. Joe Biden will be speaking tonight, 3 days before Kamala Harris speaks. And it's almost like, I mean, today is going to be tribute to Joe Biden Day, everything he accomplished, probably a lot of speeches praising him. But it's almost like they want to put Joe Biden right at the beginning and then get him out of the way, and create some distance before Kamala Harris comes on. And that could be deliberate, because one of the things she clearly needs to do is differentiate herself from Biden and get credit for the things Biden that went okay under Biden, but make sure she doesn't get the blame for things that have happened under Biden that voters don't like, and that's mainly inflation. So that's what I'm looking for. And of course, we're going to hear Kamala Harris talk on Thursday night and see. It's going to be a little bit of a coming out for her first big primetime speech.
And Rick, more specifically for our audience, I guess, how much of the focus do you think is going to be on the economy, is going to be on inflation, just given what we saw from the economic agenda that Harris's camp put out on Friday, and then also the fact that it is a critical issue here for voters this election?
I think there's not going to be that much focus on the economy, because this is not if you're focusing on wee details of policy proposals, you're kind of not, that's really not what the convention is for. The convention is to create good vibes, make it about your personalities. And for what it's worth, I'm not sure Kamala Harris wants to talk that much about the economy. I mean, for what it's worth, what I noticed about her economic plan is she is going after, she's sort of precision targeting the remaining sore spots in the economy. And that's two things in particular. I mean, we know from everything we've seen in surveys for the last 2 years, the things that really are bugging voters are that food prices and housing costs are still too high. And lo and behold, her economic plan targets exactly those two things. So-called price gouging for food, and this kind of silly idea that we're going to have, the government is somehow going to set a maximum price for Oreos and for cereal, and then these new things to help home buyers. So we may hear some of that, but I think this is going to be short on policy and heavy on personality.
All right. We'll see if we have any retired WWE wrestlers that show up as well.
Probably not.
Probably not.
That's too weird. That's too weird for the Democrats.
Rick, thanks so much. Appreciate it.
Bye,
We'll be
guys.
checking back in. We're just getting started here on the Morning Brief. Coming up, AMD makes a big deal. Plus, Estee Lauder's CEO steps down, and Fubo TV shares, they are rallying on a new deal. We've got the biggest trending tickers on the other side. And later on, Goldman Sachs cutting the odds of a recession after strong economic data. Chief economist Jan Hatzius is going to join us at 10 a.m. in Catalysts for an interview that you do not want to miss. Keep it here. You're watching The Morning Brief. Let's get to some trending tickers that we're watching here this morning. AMD planning on acquiring server maker ZT Systems for $4.9 billion, an attempt by the chip company to broaden its artificial intelligence infrastructure and compete with, of course, Nvidia. Here, taking a look at shares pre-market, holding on to fractional gains as of right now. A few things to point out for shareholders out there. Don't really look for this transaction to be accretive on a non-GAAP basis until the end of 2025. That one thing that the company is pointing out. And then additionally, you'll remember that this is the latest here in a series of investments that AMD has made to try and really strengthen and bolster their AI play, as the company noted in the last 12 months. In addition to increasing their organic research and development activities, they've invested more than $1 billion to expand the AMD AI ecosystem, as they call it, and strengthen their AI software capabilities.
Yeah, I think the big reason here for this play is because of AI and what exactly this is going to do for GPU sales. And Lisa Su, the CEO of AMD, just putting it very, transparent here within this statement, saying that it is going to enable the company to test and roll out AI GPUs at scale that larger cloud giants like Microsoft require here. It says it's also going to help them just overall sell more of those GPUs. So obviously a bullish sign here for their business. Another interesting part in all of this is that AMD actually plans to break off its server manufacturing business and sell it once this deal closes, as it has no plans here to compete with companies like Supermicro Computer. That was all according to Sue within this statement, within this release. So again, an interesting move here potentially from AMD down the line after this deal closes. So again, we are looking at some gains here in the pre-market, up just about 0.3%. Let's take a look at Estee Lauder. You're looking at shares reversing some of those earlier declines. And as it stands right now, we're actually looking at gains of just about 3% in the pre-market. The company's forecasted 2025 profit and sales came in below expectations, but they did announce the departure of their longtime CEO, Fabrizio Freda. He will be retiring after a new successor is appointed. So it looks like, at least, I was going through some of the street reaction here early to this exec change, and it looks like at least there's some optimism maybe surrounding getting a new CEO in place, a new person taking over at the helm of Estee Lauder, and exactly maybe what that means in terms of turning around the direction of the company. Bernstein was out saying that we expect that investors are going to view the change in leadership as a positive for the stock. So that, of course, explains the reversal that we're seeing in early action and why now we are seeing this move higher, despite the fact, Brad, that the consumer remains weak. And it is a obviously challenging time here for Estee Lauder, and specifically what's going on in China.
Yeah, in the business of fragrances, the shareholder returns on this company for the past 5 years have stunk. Take a look at the past 5 years. I mean, it's down over 50% here. They did have a little bit of a rally leading into and kind of post-COVID, as everybody was getting back out there. We needed to look good. We needed to have the best fragrances. I needed to do a little bit more makeup, primarily because I need to wear it every day. But all these things considered, Estee Lauder was able to capitalize on that, and that was reflected within the stock price. But then it became a larger question of, okay, how do we sustain this momentum? And there you're taking a look at that reversal that I was talking about. And so now, what will fresh blood do at the top of the helm for Estee Lauder here? Perhaps there's a little bit more of a digital-first focus. We've heard that even from Carla Vernon, who is over at The Honest Company, and how that company, who is very B2C, has been able to lean into technology. Perhaps we see even more of that element come forward at a company like Estee Lauder as well, that has already had an environment where so many of the HMUs, the hair and makeup artists that are really proliferating social media and have really catapulted social media for years at this point. Maybe that's something that they can lean into. I don't know how you can be a fragrance influencer, but there's a way to do anything these days. I mean, until there's a scratch and scent on your phone, I mean, I'm not sure how they do it successfully, but they find a way. Also, let's talk about shares of Fubo here this morning. Rallying, they are. Let's take a look at it. It's up 15%. We were taking a look at this in the newsroom earlier on. This follows a court ruling. It's a pretty big deal here that's going to temporarily block the launch of a rival sports streaming service backed by multiple media giants, including Warner Brothers Discovery, Fox, and Walt Disney. All of our minds were blowing when we heard about this joint venture months ago, and we were reporting it to you here. Now, Fubo TV, it seems like the only reason why they are rallying is because there's a successful blockage of that as of right now, and we'll see what more comes forward. I believe Fubo has a lawsuit that they're also going to be moving forward with as well on the back of this, so we'll see how successful that is.
Yeah, it says that they're moving forward with this antitrust lawsuit against the companies for their anti-competitive practices here. And this is something that we've seen a number of senators, those down in D.C., backing here. Senator Elizabeth Warren, Senator Bernie Sanders, just among those who've been sending a letter pushing here to scrutinize Venue. So in terms of what this means, obviously this is a huge blow for Venue. Just take a look at the timing of this. They were hoping to get this online ahead of the NFL season. Now that could be in jeopardy here. So obviously that would be a huge blow here to this joint streaming effort here from Fox, from Warner Brothers Discovery, and from Disney's ESPN. In terms of what this means for Fubo's business, it doesn't really fundamentally change their business. Like you were saying, the real reason, the only reason why we're seeing such a rally is because of the fact of how the judge ruled in this case. So there's still lots of unanswered questions about what exactly, how this is all going to play out. So again, there is some optimism for Fubo's stock, which is under $2 a share. It's important to point that out too, just in terms of the scale of this move. But again, lots of questions just about what exactly this looks like going forward, and what is the ultimate catalyst beyond this type of ruling for Fubo TV. All right, we're just minutes away from the opening bell on Wall Street, taking a look at how the trading day is shaping up. You're looking at slight gains across the board, not too far from the flat line, though. Much of the action staying on the sidelines ahead of what is going to be a very busy week for the markets when we got these earnings prints, and also looking ahead to Jackson Hole on Friday. We'll be right back.
Hey, let's take a look at the opening bell in just a few seconds here. We've got just about 10 seconds until that bell starts ringing. There's a look at the U.S. futures, rather. We are mixed as of right now. The Nasdaq future flat, just barely to the downside. Speaking of the Nasdaq, you got Google, Alphabet, ringing the opening bell at the Nasdaq in Times Square. And then at the NYSE, you've got Israeli Mapped in NY ringing the opening bell there. You got some funfetti on the right side of your screen. Good way to kick off the trading day here for a Jackson Hole type of week, a DNC type of week, big markets activity type of week. Why not? Let's just sum it up to that.
And we've got earnings. You didn't even mention that.
I mean,
Big week
I
ahead.
just assumed it was within the markets.
All right, guys, let's take a look at some of the moves that we're seeing higher in the major averages. Not too far from the flat line. Of course, a lot of investors here on the sidelines ahead of what Brad was laying out is going to be a very busy week here for the markets, for the economy. You do have the Nasdaq 100 here slightly moved to the upside. I believe here up just about 0.1% as we wait for that to calibrate. But at least for the S&P 500, you are seeing this slight move here to the upside. Taking a look at the bond market, the 10-year yield, slight move here in positive territory, at least for yields. We're seeing some pressure here on prices. Taking a look at the sector action, you've got consumer discretionary, communications, two sectors that are going to be in focus here this week as we talk about some of those retailers that are reporting. That is leading today's trading action. On the flip side, you've got technology bringing up the rear, the only sector here, at least to start the day, in the red, but it's early.
Let's take a look at the Dow 30 components here. You know, this is like a new thing I like to do here. Let's just take a look at how we're doing out of the gate right here, right now. Apple, you're seeing that down by about 0.3%. A lot of green on the screen. That's a good thing. And ba-da-ba-ba-ba, investors loving McDonald's as of right now, up 2% out the gate. All right, with that, I'll toss it over to Jared Blickby, Yahoo Finance's own, standing by at the Big.
Thank you. Detailed look at the People's Index, as I like to call it. Let's take a look at the S&P 500 real quickly. I'm going to show you a 2-month chart, and you can see I like to draw candlestick lines in here because it shows me the price action and the important levels. So we are just climbing over the last holdout. This over here is a record high, so would be pretty easy to get to that in the S&P 500. In the Nasdaq, you got a little bit more room to go and still haven't quite cracked that last resistance level. Arguably, there's a small one here as well. But the indices probably will be able to get to those record highs. Will they be able to meaningfully launch from there? Will they have that momentum? Well, I think it's important to point out that we no longer have the tailwind of seasonality at our backs for the most part. I'm taking a look at the US dollar, though. That is supportive of the risk on. Here's the year to date. You can see it is just barely back to the flat line right there. If you look at a 1-year chart, you can see we are at the lowest levels since basically early January. But the dollar is mean reverting. We've seen it go down a bit, and a lot of times it will just kind of break that level right there and then just proceed to the upside in a reverse and kind of fake out some traders. We'll have to see what it does this time. But let's check out the sector action. We are already going over the leaders, but I wanted to point out financials and healthcare are starting to look constructive on some longer term time frames. Now here's a 3-year chart of XLF. This is the Spider Fund Financial Select Sector ETF for large cap financials. It is just breaking to the upside and pretty constructive price action there. And it is a similar story for healthcare. That is XLV. Let's see if we can punch that up. That is up 18 basis points today. And there you go. It is broken out to the upside as well. I'm seeing some constructive action in XLC for that matter. So my point is a lot of sectors underneath the market surface are starting to perk up here. So if we do get any momentum to the upside, we're going to want to see more participation from not only these sectors that I've mentioned, but of course tech itself. That's always going to be important. Want to leave you guys with a look at our leaders index and HYG. This is a high yield debt ETF. Let's see if I can find it here. It's slightly underwater today, but here is a 3-year chart. Difficult to see here, but it is just now peaking above an important resistance level. So maybe high yield has a little bit of ways to go as well, guys.
All right, we will see. Jared, thanks so much for breaking, or I guess laying all of this out here as we kick off a new trading week. Like Jared was saying, we've got stocks hovering near the flat line this morning after all three of the major averages notched their best week of the year. The next big test for the market is going to be the earnings reports that we're going to be getting here this week, and then also looking ahead to Friday and Jackson Hole. What we hear from Fed Chair Jay Powell, that could potentially put the rally that we have seen, put it on hold if there isn't enough dovish commentary within that. So let's talk about what all of this means for the markets with our next guest. And we want to bring in, if we can keep scrolling here, Matt Stuckey. He is Northwestern Mutual Wealth Management's Chief Portfolio Manager. Matt, it's great to have you and great to talk with you again. So let's talk about what is right or what's on the line when it comes to the markets this week. Certainly there's a lot when you take a look ahead to Jackson Hole. You've got earnings report, also the DNC kicking off. What's top of mind for you and why?
Look, I mean, I think this week is going to be highlighted by traders really kind of evaluating what's in store for us in Jackson Hole, because I think that's the key to kind of the next phase of the market. Are we going to be in a market where the Fed is not so much of a headwind to asset prices, or is the Fed going to start to ease gradually and start to bring monetary policy back down from a restrictive level? There's not a whole lot of data points between now and then, but one data point that I would highlight that I think hasn't really gotten enough attention is just the Conference Board Leading Economic Index. Right now, we're in the midst of the fourth deepest drawdown in this series, all the way going back to the 1950s. And the other times we've seen drawdowns in the leading economic index to this level have been, 1973, 1981, and 2008. We're 14.7% off the all-time highs that were set at the end of 2021 for this index. And so, to me, it's just a deterioration factor that keeps going against us here as we look at kind of where the economy is headed. And so, it's important for us to kind of look to Jackson Hole to see that the Fed can start to remove the restrictive policy. We're going to find out, see what happens this upcoming Friday. But to me, I'm paying laser-like focus on kind of where LEIs are headed from here.
Is it too early for the Fed to declare victory on inflation at Jackson Hole?
I think that they're going to be awfully careful about declaring victory. I think that the most likely outcome for the meeting this upcoming Friday is a 25 basis point cut, absent some other kind of downside surprise to inflation or employment between now and then. What really kind of looks at my thinking here is just simply I don't think the Fed wants to repeat the mistake that they made in the fourth quarter of 2023. And the mistake that they made was signaling, an aggressive path of rate cuts in 2024. And here we are in the month of August, and we haven't had a single cut yet. What happened back in the fourth quarter of 2023 is that investors as well as business owners started to take that expectation of Fed cuts that signaled from the Federal Reserve speakers, and that started to influence their behavior. You started to see activity pick back up. You started to see loan demand pick back up, and that reignited that upside surprise to inflation that we saw in the first quarter of 2024. I think the Fed wants to be a little bit guarded against that as we think through the next couple of quarters. Certainly they would like to ease policy, but they don't want inflation to reinvigorate back higher and have to start the process all over again.
So then, Matt, in terms of what the market is pricing in right now, is the market too aggressive? Maybe not so much for the September reading, because it seems like, just about 72% of traders are expecting that 25 basis point. But going beyond September in terms of the number of cuts we're expecting here before the end of the year and then into 2025.
Well, if you think about it, if inflation is indeed moving back down sustainably to 2%, and we can debate whether or not it's going to happen, but if that is the case, there is room for about 4 cuts, according to just some back of the envelope math with the Taylor rule here. The Fed increasingly is becoming more restrictive as inflation is coming down. And taking a percent off or so with the Fed funds rate essentially just gets the Fed back to where they started this year in terms of kind of where monetary policy sits relative to current economic conditions. So I don't think the market's getting over its ski tips in terms of pricing in cuts in between now and the end of the year, and somewhere between 3 and 4 cuts. Where we do have some concerns, though, is that if you don't see inflation continue to decelerate back down to 2% sustainably, and here the sustainable part of the picture is whether or not wage growth kind of moves back to sustainable 3 to 3.5% levels. But if indeed inflation gets down to 2%, I don't think that the market's overpriced in terms of what's discounted here in terms of Fed cuts.
Matt, just lastly, while we have you, we got some of the favorite household retail names that are reporting earnings, whether you like holes in your jeans at Urban Outfitters, or whether you like things for discount at TJX or Ross stores, or if you just are working on a DIY project at home with Lowe's. A lot of reads on the consumer, and I didn't even mention Target, of course, with the grocery aisles as well. What is your general sense of where the consumer stands right now, and what we're set to hear from how all of these executives are going to need to identify where there are cracks or where there is strength in the consumer?
I'm sure a lot of guests on your show have talked about kind of the K-shaped economy that we're in today. And I think that's also being reflected in the retailing earnings reports that we've seen. Look, if we're looking at something like a Target or something like a Walmart or a Costco, the core business is performing quite well. But within the business, there is a migration towards trade down across all different consumer types. And trade down just meaning that you're a little bit more discerning about kind of where the incremental dollar is spent, with an emphasis on value versus kind of more of the discretionary purchase that occurs for a lot of retailers without their end consumer really thinking about it. So I think that environment is likely to persist for a while. Especially until you start to get into kind of an upswing in terms of consumer confidence, as well as an upswing in employment. That's just not the conditions that we're sitting with today.
Matt Stuckey, who is the Northwestern Mutual Wealth Management Chief Portfolio Manager. Matt, great to catch some time with you. Appreciate it. Coming up, we will get a pulse on the U.S. consumer after last week's strong retail data and Walmart's results. Are things as good as they seem? We'll debate on the other side.
Stronger than expected results from Walmart and a hot retail sales print helped ease some worries about the health of the U.S. consumer last week. But with a closer look inside those reports showing that shoppers are still hunting for deals, is the consumer actually weaker than the headline numbers suggest? Here to discuss, we want to bring in Michael Baker. He's D.A. Davidson's senior analyst, also joined by Brian Gildenberg, managing director at Retail Cities. It's a global retail data and insights firm. Great to have both of you, Michael and Brian. Michael, let me start with you. When we're trying to figure out the strength of the consumer right now, or the weakness of the consumer, it almost looks like you can pick out from a number of data prints to support any sort of argument that you're trying to make. So I'm curious, just from your perspective, what is your assessment of the consumer at this point?
Yeah, we think the consumer is slowing. We're in the weaker camp. And in fact, we wrote a report, we called it a mid-year theme update a couple of weeks ago, where we cut all of our numbers for the second quarter and said most retailers will guide down for the back half as we are seeing enough signs of slowing. We did say at that point that there's going to be an exception. One big exception is going to be Walmart. They're going to take market share. So their really strong number was a function of market share, not necessarily the strength of the consumer. The retail sales number that came out last Thursday was a little bit stronger than expected. We do think there's some calendar issues in there in terms of more weekday days than this July versus last July. Reverse what happened in June. Remember, so July looks better. June was very weak. When you combine the 2 months, we're growing at about 3%. That's below average. Usually retail grows 4% a year. So it's definitely a slowing environment, we think, despite those data points from last week.
Brian, would love to hear your perspective, especially considering that Walmart is such a behemoth that there's pockets and aisles that may be analogous or applicable to other spaces within retail, but not all of it.
Well, yeah, I think Walmart sells a wide range of things and to a wide range of people. I think there's a couple of things that are important to keep in mind. Number one, July is an unusual month in that I think yes, the calendar was an issue, but I also think Prime Day was a big deal in there. Amazon's Prime Day and the selling that went around it, notably from Walmart and Target, I do think actually had a material impact on retail performance across the board, and I think probably helped Walmart and will also help Target in discretionary spend going in when they report this week. I think the other thing to keep in mind is look, if you compare and contrast Walmart, Home Depot, and Amazon are the three biggest retailers that have reported. Walmart was relatively consistent on the consumer. Home Depot, to parallel the guest you had on earlier, Home Depot really wasn't talking about trade down. They were talking about trade out. People have just stopped spending on high ticket discretionary projects. I think a lot of that is due to the nature of inflation in the U.S. right now, which is so shelter centric. The CPI at 2.9% last month was almost entirely driven by increases in shelter costs. And a lot of those are deeply regional, and a lot of those are being constrained by higher interest rates. So I think it will be interesting to see over time, as the Fed lowers interest rates, which everybody thinks they'll do, the impact that has on liquidity in the housing market, the impact that has in unplugging the logjam at the top of the rental market. And I think that'll help retailers that are selling to renters that are trying to make ends meet in places like Virginia Beach, DC, Chicago, and Houston, where rents are basically up double-digit year over year. So I think there's a lot to watch.
So, Michael, I'm curious to get your thoughts on that. The catalyst for retail stocks. How much of that is dependent on the rate, on the Fed cutting rates? And then when we talk about whether or not maybe that is going to return some of that momentum to retailers, what does that bounce back look like?
Yeah, I think it actually sets up to be a pretty good environment for retail stocks. Retail stocks typically outperform the market in periods when rates are coming down. So why are rates coming down? Rates are coming down because the economy is weak. So it's a little bit counterintuitive, but we actually think we're in an environment where bad news is good news. The economy is slowing. That's going to compel rate cuts. And again, that's usually good for retail stocks. Retail stocks outperform in that kind of environment. So we think fundamentals, we're not that enthusiastic about, but stock prices, we do think it's a good environment to buy some stocks that have really underperformed year to date.
Brian, I mean, I'm not going to put you in an economist position, but is that bad for the Fed if you have a consumer that's so paying attention to rates cutting down and in a cutting cycle would be a little bit more gleeful to go out and potentially spend? What does that signal for the risk of inflation spiking again for the Fed?
Well, I think it depends. I do think that if you're talking about people that have just deferred purchase, then I think there are selected categories that interest rates will actually change shopping behavior in. I think to the point my fellow guest is making, the change in narrative around retail stocks will probably be greater than the change in consumer behavior as interest rates move. With the specific example of retailers that are basically kind of what I call America's balance sheet, Home Depot and Lowe's, the interest rate driven purchases that fuel a lot of Home Depot and Lowe's business are related to home equity and moving and things like that. America's income statement, i.e. Walmart, I mean, interest rates do affect people's income statements, but to nowhere near the degree that they impact their balance sheets. So I think it's probably sensible to look at the retailers that are more balance sheet centric as interest rates move in terms of their actual performance changing. I agree overall that a lower interest rate narrative probably helps the retail stock environment overall.
So, Michael, let's make this actionable here for investors. In terms of what you do like in this environment, given some of that uncertainty, who is best positioned besides Walmart?
Well, a name that we upgraded at the end of June is Home Depot. And the call was that fundamentals are weak and are going to stay weak probably through the end of the year. In fact, they did miss the second quarter comp estimate. But our call was, again, that bad news is good news, and we're getting, certainly closer to the beginning of an easing cycle, and the stock is going to anticipate that by at least 6 months. So we know fundamentals are bad at Home Depot. Again, they missed the second quarter, but we upgraded it in front of that, again, under the idea that the stock is going to anticipate a recovery. As rates come down, it'll take a couple quarters, call it early 2025, for fundamentals to get better. But the stock is going to, and already has been, anticipating that. Home Depot, again, they missed last week. Stock has been up every day since.
All right, Michael Baker, D.A. Davidson Senior Analyst, and Brian Gildenberg, who is the Confluencer Commerce founder and CEO. Thanks so much for taking the time here, discussing all things consumers. Appreciate it.
Sure.
Thanks.
Coming up, we're taking a look at what's trending on Yahoo Finance, and we're breaking down why. That's right after the break. We're taking a closer look at Yahoo Finance's trending tickers. 7 and Holdings, 7-1 Holdings, Dutch Bros, and Sweet Green. We're doing it in 30 seconds each, so let's go. All right. 7-I Holdings shares rallying this morning, and this is after the Japanese owner of 7-Eleven, that's how we popularly know them, they received a takeover offer from a rival Canadian convenience store chain here. There you're taking a look at the shares. They're moving up by about 22% as of right now. Of course, everybody knows that we just moved through last month, National Slurpee Day, 7-Eleven, July 11th here. But this is one of the world's biggest convenience store chains and businesses. Over 80,000 locations in almost 20 countries, I think 19 countries here. They said I'm at time. I could talk more about this.
There you go. All right, let's move on to the second stock, and that is Dutch Bros. Shares in the red here this morning. Piper Sandler downgrading the stock to neutral from overweight, saying it sees the coffee chain as a higher risk, higher reward situation because of the broader industry, some of the trends that we are seeing there. The firm also tempered its view on the fast casual restaurant sector overall. So, of course, that's something to keep in mind as you're trying to figure out where exactly they see some of the trends going, and also just as we try to figure out the better strength of the consumer at this point. They also went on to say that the stock's risk reward has become more balanced at share current levels, but still has the ways to go. And you're looking at the stock trade just under $32 a share.
All right, let's also take a look at one other one. Piper Sandler was busy this morning, churning out more of those downgrades. Sweet Green shares plunging. The firm downgrading the salad chain to neutral from overweight, citing a more balanced risk versus reward at the salad chain's current share price here. They're taking a look at the salad business right now, the shares of which down by about 5.2% here. As we mentioned, they were busy this morning. The analyst said that there was more risk reward, and that was really the cause for the rating chain. I haven't been to Sweet Green in a while here, but the salads are expensive. The same as the burgers that also got a downgrade over at Shake Shack this morning.
Across the board.
The war on lunch at Piper Sandler this morning.
They're seeing a weakening across the board of the consumer, at least weakening trends. Maybe that's fair to say. And obviously the restaurant sector, they see taking a bit of a hit as a result. Coming up, recession fears are easing, at least for some. Goldman Sachs cutting the odds of a recession after a strong week of economic data. We're going to talk to the man behind that call at Goldman Sachs. He's Goldman Sachs chief economist, Jan Hatzius, joins us after the break next on Catalysts. It's just after 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills, and let's dive into the catalyst moving markets today. Stocks are on track for their 8th day of gains ahead of a crucial test for the markets this week, and that's Jackson Hole. Fed Chair Jerome Powell set to deliver remarks on Friday.
And better than expected economic data has Goldman Sachs trimming its recession probability to 15%. That's down from 25%. We'll talk to Jan Hatzius, the chief economist at Goldman, about that call next.
Plus, Nvidia holding onto its gains after its biggest upside move in 15 months. Could its upcoming earnings report be another catalyst for the stock? We're going to discuss what's next for the chip giant and the broader tech sector. But first, let's get to that recession call. The current easing of recession fears, moderating inflation, and stronger than expected retail sales sparking a rally in stocks. The S&P 500 and the Nasdaq have now recovered all of their losses from the sell-off earlier in the month. The data also spurring economists like our next guest to lower their recession calls. We want to bring in Jan Hatzius. He is the chief economist for Goldman Sachs, and our very own executive editor, Brian Sazi, joining the conversation as well. Jan, it's great to have you. There's lots to get into here today, but let's start with your recession call, because just about 2 weeks ago, you actually raised the probability of a recession from 15 to 25% following that weaker than expected jobs print. Today, you're lowering the chances of a recession. What makes you more confident in the economy?
Basically, the better data that we've seen since the weaker than expected employment report. And I would highlight last week's retail sales number, the core number up 0.3% in nominal terms, 0.7% in real terms. I'd also highlight the decline in the jobless claims numbers over the last couple of weeks. And lastly, I'd say that when we look at the earnings reports for the second quarter, we thought that was actually pretty encouraging. We have a diffusion index which looks at the share of S&P 500 companies that have positive commentary versus negative commentary on the consumer. That edged up on a quarter-over-quarter basis, and all of that to us says that the economy is still doing fine. So we raised our recession risk estimate from 15 to 25% 2 weeks ago. We lowered it from 25% to 20% over the weekend. And we also said that we'll probably take it down further to 15%, assuming the next employment report on September 6th looks okay or better.
So then, Jan, what does all that mean for the Fed? If you are expecting maybe an employment report that doesn't show those fears that maybe we did see a couple of weeks ago about weakening in the economy, and you expect maybe to lower the recession odds to 15%, how does that game out then for the Fed and what the Fed should do?
So the lower recession risk has strengthened our forecast that they will cut by only 25 basis points at the September meeting. That's been our forecast for a long time. But I think with more worries about recession, there was a real possibility that it might be a 50 basis point cut. And while I still wouldn't rule that out in case the next employment report is weak, I think 25 basis points is a lot weaker. Is a lot more likely. Beyond the September meeting, we're expecting 25 basis point cuts also in November and December for a total of 75 basis points of easing this year.
Jan, Brian here. Always nice to get some time with you. What's your read on the U.S. shopper? We have Walmart executives telling Yahoo Finance that they're getting a higher income shopper walking through a Walmart store for great deals. We have a lower income consumer that's still having problems dealing with grocery inflation. What's your read on the shopper here as we look towards the back half of the year?
I think the consumer is doing fine, and we can see that in the macro data like last week's retail sales report for July, but we can also see it in the bottom-up numbers from the second quarter earnings reports. Again, our diffusion index of positive minus negative commentary edged up and has been rising over the last couple of years. So there were definitely some anecdotal reports of caution at the lower end of the spectrum, but I would put that in perspective, and I would say overall the consumer is still doing okay.
If the Fed cuts by 25 basis points in September, do you expect consumer spending to accelerate significantly into the end of the year?
No, I would expect continued moderate growth in consumer spending in the range of 2%, maybe a little bit above 2%, which is basically what we've been seeing. I don't think we're looking at an acceleration. I think we're looking at continued steady growth as the economy proves resilient, stays out of recession, and the labor market stabilizes. We also don't expect further increases in the unemployment rate from here. We've seen an increase from 3.4% in the spring of 2023 to 4.3% now. We have that basically going sideways to slightly lower going forward.
Jan, I want to talk to you about the housing market. You have a chart in your latest note on the real estate sector having the most mentions of recession over the course of the earnings calls so far this quarter. And it just made me wonder about how much the housing market, in your view, may be divorced from the Fed or the broader economy. What is your thinking on the state of the housing market?
Yeah, I think the housing market has suffered from a tight monetary policy, from a high level of mortgage rates, much higher than what we've been seeing for many years prior to the 2022-23 hiking cycle. So I think housing is still soft. We saw that in the housing starts numbers last week. We've been seeing it in the home builders index. However, I would expect that to gradually improve as interest rates come down. So that's one area where I do expect some improvement. On the consumer, I would say steady, but as far as housing is concerned, probably things will get somewhat better at the margin. But the commentary is relatively negative, as you say, but I don't think that's going to last.
Well, that negative commentary is certainly going to be a big issue for two people right now, and that is the two people who are running for office come November, Trump and Harris. I'm curious, from your perspective, what letter grade would you give the economic policies of both Trump and Harris as they've really started to narrow in on those policies over the course of the last week here?
So we're not really in the business of assigning letter grades to political candidates. I do think that obviously there are some important potential changes in policy, and I think there are some differences in fiscal policy with an extension of the tax cuts that were passed in 2017 if President Trump wins again. I think, on the other hand, there's going to be an increase in tariffs probably in a second Trump administration. We have looked at this. Obviously, the impact on inflation and growth is going to depend on how much of his plans would actually be realized. But it would probably increase inflation, and it could increase inflation, at least over a shorter period. It's more of a price level effect, but those would be important effects on the economy and potentially also for Fed policy.
So, Jan, what is your assessment of Harris's agenda so far? It was light on details, but just in terms of her priorities and what she is aiming to do when it comes to price gouging, some help with the housing market, do you have any first look or first insight maybe into how you think that could potentially affect the economy?
Look, I think the main thing as far as a Harris presidency is concerned is that I think it would be a continuation for the most part of President Biden's economic policies. I think very likely we would see an increase in taxes, especially at the higher end of the income spectrum. So the top marginal income tax rate would, undoubtedly rise back to the 39.6% that we were at until 2017. There are some additional sizable tax hikes in the program, and so I think those are important fiscal effects that would have an impact.
Yeah, and just listening to your take on both of them. So if President Trump wins, might get more inflation because of potential tariffs. If Vice President Harris wins, we might get higher taxes. Do investors really understand that whoever wins the White House, we might be headed to just a 4 or 5 years or a decade of slower growth than many people have come to expect?
Well, I'm not sure that we're going to have slower growth. I think there are certainly economic policy challenges, and we do have a very large federal deficit that will need to be brought down over time. And that is going to weigh on growth, at least in the short term. But there are also some important positives. And I would say the impact of continued strong labor force growth, though probably not as rapid as what we've seen in the past couple of years because of the immigration surge, but still healthy labor force growth and productivity growth that has been pretty encouraging as well. We do think that over time we'll see a bigger impact from generative AI on productivity growth, and we have raised our longer-term potential growth estimates for the U.S. From a little under 2% to a little over 2% in the early 2030s. So there are many uncertainties around the economic outlook, but I certainly wouldn't say that they're all in a downward direction.
Jan, since you mentioned generative AI, I want to wrap up there. What are your models telling you about the impact that generative AI could have on the labor market moving forward? And I ask for the audience out there listening who are concerned about the labor market and just the strength of the labor market right now.
Look, I think that the flip side of stronger productivity growth is going to be job losses in areas that are particularly impacted by generative AI. And that's really been a hallmark of technological progress, for not just the last century, but really the last several centuries. Our expectation, though, is that we'll find what we've found time and time again. As there are fewer jobs in one area, you see an increase in jobs and renewed job creation in other areas. So I wouldn't say that this is a factor that's going to increase the unemployment rate over time, but it will accelerate structural change in the labor market, as it has done for many, many years.
All right, Jan, thank you so much for joining us. We really appreciate you coming on the program. Jan Hatzius, he's chief economist for Goldman Sachs. And Brian Sozzi, you are going to stick with us right here for our next story as well. We're going to take a look at markets on track for their 8th day of gains after its best week-long run since 2003. You're taking a look at gains across the board. The S&P up 0.2%, the Nasdaq nearing 0.2%. The market's fully recouping their losses from the early August sell-off. The big question, how fragile is the current rally? We've spoken to strategists and economists throughout the month about exactly that.
So I think what you saw Friday is people got a little bit, shocked or scared out by that weak labor market report. And that's just going to be an ongoing process, I think, over the next kind of 2 to 3 months.
It's too late to panic that much of what we saw was a short covering situation vis-a-vis the yen. Looking ahead here, I think we're going to see the market continue to churn below the July 16th high.
I mean, the markets have had a very strong comeback from that August 5th sell-off. Yeah, I think a surprise would trigger volatility and a sell-off.
And guys, just to continue that idea of the markets kind of recovering here, we know from Bank of America, they've had their 7th consecutive week of inflows into equity funds, and tech funds in particular have continued to see inflows in the same time period. And that's interesting given that tech was kind of the biggest sector that was under pressure during that market rout we saw in early August.
Yeah, well, just listen to our friend Jan Hatzius from Goldman. I'd be concerned about where this market is. And given it has rallied after that jobs report, we had Jan talking about potential tariffs from President Trump winning the White House again, leading to more inflation. You have him calling out Vice President Harris wins. That could lead to higher taxes and lower growth. I mean, none of that makes me excited about own stocks. I will say this, though, on the other side of it, a really good note from RBC's Lori Calvasina this morning. She's noting that we're starting to see growth begin to outperform value again. I suspect that is likely a function of people expecting a rate cut at that September Fed meeting, usually good for growth stocks and growth PE multiples. And number two, she also mentions the median PE of the top 10 names in the S&P 500 has rebounded to about 26.6 times, but remains well below recent highs. So maybe some investors are out there looking for bargains. But still, what Jan was telling us, kind of scares the crap out of me.
And I think that also kind of reinforces what we heard from Yardeni, what we heard from Stuart Kaiser, what we've heard from a long list of strategists and even economists who have joined us over the last 2 weeks as we try to make sense of the weaker than expected labor print, also the unwinding of the yen carry trade. And I think to sum it all up, there's a heck of a lot of uncertainty right now within the market. And investors are trying to figure out, going to Calvasina's call, what makes the most sense to buy at this point. And obviously there's general consensus just in terms of concerns about valuation. Jim Paulson, the longtime strategist, was out the Substack this morning actually making a strong argument, I thought. He was talking about the fact that, yes, we're entering this third year of a bull market, but there is a lot to like when you compare to historically what happens in the third year of a bull market. Yes, there are typically valuation concerns, but it's more broad-based. And here we have more of a concentrated argument, at least at this point. And he also went on to talk about a number of other factors that could really boost some of that movement in the long term. A lot of that also having to do with we're expecting the Fed to cut rates. That could be a catalyst here for the markets, potentially in the short term, just as long as the economy doesn't deteriorate too much. But I think that all points to the fact that there is so much uncertainty right now, and people are a little bit nervous here to call it too much one way or the other, and that's why we're seeing so many investors stay on the sideline.
Jim's still at this. I love Jim. I got to sign up for his Substack. I mean, Jim is
good.
Jim is really good. At the end of the day, I appreciate the market is rallying. Nothing can go down forever, but I come back to this. Is a 16% sales increase at Chili's last week. Is that a good thing? Is that a good economic sign? Does that get you excited about owning stocks? To me, that suggests the consumer trading down for a half a pound burger. Don't know if that's a good thing.
Yeah, exactly. And then there's a lot to support the fact that the consumer is weakening here and a lot to be concerned about in the short term. All right, Saz, great stuff. Thanks.
Yeah, peace out.
Let's talk about Nvidia because shares, they're a bit flat today, but coming off a massive rally last week, the stock surging almost 19%, its best weekly gain in over a year, snapping a 5-week losing streak. Now, the next big test for the stock, it's going to be its earnings report next week. We want to bring in our very own Dan Halley, who is tracking that. And Dan, everyone's trying to figure out whether or not earnings are going to live up to the hype and whether or not it's going to be a catalyst for the stock. So what are you hearing?
Yeah, Shauna, it's going to be interesting because there's a few factors going on here. First is really kind of the ailing AI trade overall. And I say ailing in the sense that over the last month, companies like Microsoft, Amazon, and Google have seen their stock prices fall. They've recovered slightly from what they were last week, but they're still negative in that last month of trading. For Nvidia, as you said, the test comes when they report earnings, and the issue really comes down to the expectations and how it's outperformed in prior quarters. So just give you a sense, we're looking at a potential $28.6 billion of revenue. That's what analysts were calling for as of last week. That would be a 112% year-over-year jump over the company's $13.5 billion they recorded in their fiscal Q2 2024. Their fiscal dates are a year ahead. In their most recent quarter, though, Nvidia reported $26 billion in revenue. That was a 262% year-over-year increase. So you see that difference between the 112 and the 262. The reason being is because they're just coming up against these difficult comps from when they really saw revenue start to explode. And you know, the question has been when that starts to kind of come back down to earth. I mean, obviously 112% year-over-year growth is massive, but I'm comparing it to that 262%. Some investors may start to think, well, is the ride over? And so I think that's something that's going to be kind of looked at pretty closely when it comes to the earnings this coming quarter. The 28th is when they're going to report. And then the other thing, obviously, is going to be what their outlook for the current quarter will be. What kind of growth are they expecting there? And those, I think, are going to be the two big things that customers watch. Also, any commentary on the Blackwell chips. The information reported that NVIDIA is having trouble getting them out the door. NVIDIA basically came out and said, we're on track to ramp production in the second half of 2024. And so that's more or less staying with what they've said in the past. So it'll be interesting to see if we get any kind of commentary there. But like I said, the main issue is going to be, will investors still be on board with that, again, slowing, but still massive growth that they're seeing.
All right, Hallie, we're going to wait and see what we hear from Nvidia next week. Certainly a lot riding on that report. Hallie, thanks so much. Keep it right here on Yahoo Finance. We've got much more of your market action ahead. Again, you're looking at a mixed picture as we kick off a brand new trading week. You got the Dow trading to the upside, up just about 0.2%, but the Nasdaq and S&P 500 now trading below the flat line. You got the Nasdaq as the underperformer here so far today. We'll be right back.
Activist investor Carl Icahn agreed to pay $2 million to settle a probe from the Securities and Exchange Commission. That probe coming in connection with Icahn's alleged failure to disclose pledges of his public company's securities as collateral for billions of dollars in personal margin loans. Here with the details, we've got Yahoo Finance's senior legal reporter, Alexis Keenan. Hey, Alexis.
Good morning. Yeah, so these charges are just being disclosed here by the SEC, but also a settlement contained in these charges saying that Icahn and Icahn Enterprises violated the SEC's disclosure laws for reporting on pledges of IEP stock as collateral for what they say is billions of dollars of personal margin loans dating all the way back to 2018. So we're talking about almost 6 years here. Both the firm and Icahn are going to pay a total of $2 million. That's a fine, civil penalties to settle this matter without admitting wrongdoing here. Now, the SEC's head of complex financial instruments division, he said these disclosures would have revealed that Icahn pledged over half of IEP's outstanding shares at any given time. When you look into the documents here, which I've done just briefly, you can see that the pledges were from 51% to 82% of IEP's outstanding securities at these given times. So we're talking about significant leverage here. So of course, the purpose of the SEC's laws in this regard are to protect investors so that they know about these types of margin loans. And of course, if you remember back about a year ago, a little bit more than a year ago, Hindenburg Research had that report back in April 2023, and at that time the stock had just fallen off a cliff. At the time, they were accusing IEP of operating a, quote, Ponzi-like structure in order to pay its dividends. Thereafter, months later, if you remember also, the company cutting down its dividends significantly, if not something like half.
I'm curious about the financial piece because $2 million.
It sounds like a slap on the wrist, right?
It's nothing.
Yeah, we're talking about even now, 7 plus almost $8 billion under management here with market cap for the company. So $2 million doesn't sound so bad, does it?
But I also think it's using Icahn maybe as an example,
Yeah.
right? Just in terms of how recognizable his name is, what exactly
Sure.
could happen when this type of activity, I guess, occurs. So interesting here to watch, right? Alexis, great stuff. Thanks.
Thank you.
Let's take a look at some trending tickers. First up, we've got McDonald's. It's the leader in the Dow today. You're looking at gains of just about 2.5%. Evercore saying it is increasingly bullish on the name. The firm raising its price target on the stock to $320 from $300. Reasons as to why. Citing strong brand recovery going into 2025. And I think a lot of this has to do with the fact that consumers are hunting for value. Because of that, they're increasingly bullish on some of the market share trend improvements that we have seen from McDonald's. The value meal, some of the priorities that we have seen from McDonald's as they try to capture more and more of the consumers who are a bit strained. And as consumers do pull back on their spending, they're doing everything they can to still capture the dollars that are being spent. So because of that, Palmer writing here within this note that he believes the company will be more effective in pursuing the multifaceted approach to value and stepping up the pace of menu introductions at both premium and medium price tiers. And he really sees that unlocking value here for McDonald's going forward.
Yeah, and to the discussion that we've been having kind of throughout the day, McDonald's is one of the consumer-facing companies that has certainly been under pressure. You can see there it's down 4% year to date. It's one of the companies that came up in Jan Hatzius's note about the broader earnings cycle and what we can glean about consumer health this earnings cycle. McDonald's being one of the companies that did talk about that consumer weakness being a challenge for them, even in the face of some of the deals that they were putting on to try and get more foot traffic through the door. That wasn't enough this quarter for McDonald's. Having said that, Jan was obviously a little bit more bullish about the forward outlook for the economy when you look at the broader earnings cycle so far this quarter as something that is a little bit more optimistic, and maybe there were some idiosyncratic pieces of consumer weakness. But having said that, that might also be why Evercore raising their price target on McDonald's. Well, shares of HPQ are moving lower after Morgan Stanley downgraded the stock to equal weight from overweight, saying the company has limited upside and the PC market recovery is already mostly priced in. Now, this is a call that seems primarily based in a valuations concern about HP. And you can see that the stock is certainly under pressure following that downgrade over that valuation concern. Their previous positive stance was based on the view that the market was not appreciating the return to personal systems revenue growth, stable print margins, and accelerating capital returns. But again, as we just mentioned, that is already priced in, and the risk profile does seem balanced for now. That is according to this Morgan Stanley note. The price target, interestingly, was unchanged at $37. That is implying about a 3% decline, or increase rather, from Friday's close. Still, though, that downgrade coming in from Morgan Stanley.
Yeah, a lot of this is just because of that valuation call, right? What is being priced in? They believe that the recovery, what had made them a little bit more optimistic about this stock going back a few months, has now fully been priced in. Their price target a little bit higher than where we are trading today, up just about 2 or 3%. So their new price target that did remain unchanged, right at $37 a share. But again, when you take a look at how the street overall views this name, you've got 8 buys, you've got 8 holds, and 2 sell ratings. So between the 8 buys and 8 holds, you can see that stock or Wall Street still pretty mixed right now, or split, I should say, just in terms of whether or not they still see an opportunity or reason to buy HPQ at these levels. Well, coming up, the DNC kicking off today in Chicago. What could we be hearing about potential economic policy in a Harris White House? Got that for you next. The Democratic National Convention's kicking off today in Chicago, and it culminates in Vice President Harris's speech on Thursday night. Now, Harris is expected to lay out her economic vision for the next 4 years. Here to discuss what Democrats need to do to win over undecided voters, we want to bring in Steve Schmidt. He is the author of the Warning Substack newsletter, as well as former senior advisor for John McCain's 2008 presidential campaign. It's great to have you here. So I think that is the big question that so many political strategists and even Americans are asking themselves right now. What exactly do Democrats need to do to win over that undecided voter, which is going to be and always is so critical in these elections? What do you think?
So first off, this convention comes in this moment in time after this remarkable run after the sudden transition from Biden to Harris. The first night of the convention is really the valedictory of the Biden's political career. Both Dr. Biden, the president, will be speaking, and they pass the torch. The president will seek to encompass the Harris campaign as really an extension of his unfinished campaign, his presidency, and then the rest of the week will be the next generation moving past all of this. What the vice president has to do is fundamentally what Vice President Bush had to do in 1988. He was not particularly defined. In fact, the man who was the youngest fighter pilot in the U.S. Navy shot down in combat was lambasted as a wimp on the cover of Time magazine. And he delivered one of the historic and best convention speeches that there's been. That speech, written by Peggy Noonan, is really a model for the vice president here to introduce a philosophy, how she sees the country, how she sees life, how she sees opportunity, the American dream, and where people fit into the economy. Important to understand, 40% of the country doesn't have $400 cash available for an emergency, and she will be addressing those people as well.
So, will Harris's economic plans be able to sway Trump voters?
No, there is not much swaying to be done. What there is, when you look at Trump and how he wins, it's a coalition that has intensity, some fanaticism, but relies on the apathy of people turned off to politics who wouldn't show up. So with Biden out of the race, there's been a surge of interest in the race from Gen Z, from young people. The bleeding that you were seeing with black voters going to Trump young men has stopped. People saying they're not going to participate has significantly lessened. What this is about turning out your base. There is an incredibly small slice of voters that exist in the 6 states that will really determine the outcome of the election. This is about turning out your people, and that small group in the middle is trending in Harris's direction. She wants to solidify it by not offending it in any way, shape, or form. So her economic policies will be delivered as sentiments, not as specifics.
Well, I think you just hit on a lot of the criticism for the Harris campaign, which is that there isn't a lot of specifics within the policy positions, including the economic plan that you and I just spoke about. But given what you just said, could specifics be a headwind for the campaign?
Listen, we live in a country where a guy got elected president, and I remember this because I'm old enough to remember it, saying that we were going to build a wall paid for by Mexico. I mean, that was the specific. As a matter of political strategy, there are some elements in the media that may say, hey, we want specifics. Voters don't want specifics. Not in this moment in time, not in this era. What would be good is a articulation of some sense of better, a philosophy, a direction. Entitlements in the country, for example, are going bankrupt. The Social Security Trust Fund is insolvent. What is her view on these issues? We're not going to find out much about any of it beyond the platitudes, beyond the sound bites, and a rank order of how they test in a survey on the issue of their popularity in the electorate. She's winning. It's working. She'll have a bounce out of this convention, which historically dissipates by half within 10 days of the conclusion. And this will be a slugfest, remembering that the last election was decided really by 44,000 votes across 3 states. And though she has had momentum, there will be bad days for the Harris campaign, and she will be tested in those bad days, in those moments over the fall.
Now, Steve, just going back and given your experience, your insight of what has happened in past elections, those candidates who do typically end their conventions in this upswing, that do have this momentum, let's theorize that maybe Kamala Harris is able to do that here throughout this week. What does that then typically signal just about the election come November? Do we typically see them then carry that momentum through November and ultimately win the election?
It's like stepping on the gas of a car and then taking your foot off it without touching the brake downhill. Eventually, that speed will slow. And so that convention bounce, like I said, usually dissipates. Now, John McCain came out of his convention with a huge head of steam, and then the economy collapsed. Lehman Brothers went down. So the one thing that is most discounted in politics, in a presidential campaign, as we assess everything in the moment and through the prism of what has just happened and happened over the last year, is that it doesn't take account into the big thing that's about to happen, a terror attack, the start of a war in the Middle East. Who knows? But there are events that will take place between this moment and the closing of the polls in the next 77 days that will have an impact on the election. And if you're taking score at home, really the way to know who is winning this election is this way. Whomever it is about is going to lose. And so Donald Trump was losing in 2016 till James Comey made it about Hillary Clinton by enough that he wins narrowly. Whomever it is about, it was about Biden, and he was driven from the race. Kamala Harris has done a great job of keeping the focus on the race about Trump. This convention will be cast around the notion of freedom and Trump as a threat to it. If they can keep the focus there, that's where they want to keep it. That's the sweet spot where that very small sliver of undecided voter is, and they will break on the issue of freedom towards the party that embraces it.
All right, Steve, we got to leave it there. Thank you so much, as always, for joining us.
My
That was
pleasure.
Steve Schmidt, political strategist and author of the Warning Substack newsletter. Now, coming up, we're going to take a pulse on the retail investor and how they've been responding to uncertain market activity with Robinhood's financial head of investment strategy. That's next. Markets still on track for their 8th straight day of gains following a spike in volatility amid that temporary market rout. Now, for retail investors, the recent sell-off was a buying opportunity. That's according to data from Robinhood. Here to discuss how retail investors are positioning around market moves, we've got Stephanie Guild. She is the financial head of investment strategy at Robinhood. Stephanie, great to have you in studio. Thanks for coming in. So let's start on what you saw in terms of retail investor activity on the platform around that sell-off. What was the biggest takeaway for you?
A couple of things that we see all the time. It was buying the dip, especially in the names that had done the worst. And that was around like semiconductors particularly. Actually, over the last month, that has been the biggest buying. And if you look at something like a Nvidia, it was down 2 times the amount of the Nasdaq was over that same period. So it makes sense that they were buying more of that. We also saw a ton of volume just in general and sort of net buying rather than net selling overall.
What does that signal to you? Does that mean that maybe investors still find reason to be bullish or buying these dips? They like maybe what the trajectory looks like in the long term, and they're able to look past some of that uncertainty over the next several months?
Yeah, I think that absolutely. And we see it all the time, actually, just when you look below the surface. Even though up until July we had a bull market, you had consistently customers on the margin buying more of the things that had come down and trimming, I should say, selling the things that had fallen off. So Apple had been a place where there was some trimming more recently, but had been a place where there had been more buying earlier in the year when it hadn't been doing as well.
Does that indicate to you that it's more specific to chips than the broader tech rally for retail?
I think in this case, I think so. Like I think you had such a pullback in the chips, and I think our customer base thinks long-term. EVs, electric vehicles, tends to hover around 20% of the index. And semiconductors has been a growing share of that as well. And so I think our customers really do think like, what is the future? Not just the next couple of years, but 10, 20 years, and what will be the most important companies then.
Stephanie, what are you seeing just in terms of the appetite for crypto and Bitcoin? Because we have seen a bit of a bounce back, although crypto is still underperforming the bounce back that we have seen in the broader major averages. Are they finding reason to buy? And I guess what does that then further signal to you as we try to kind of read through the lens?
I think so. Crypto is certainly seeing a lot of volume in the pullback, or that we had in the pullback as well. I think also, generally speaking, there is at least a subset of investors that still give pause to the government and quantitative easing and the deficit that we have. And I actually think that does drive, amongst other things, drives continued interest in crypto.
It makes me wonder too, just about, and going back to what you were saying about tech in particular, the earnings that we saw from a company like SMCI, and I know you talk about this in your note. Yeah. What did that indicate to you about, guiding higher on sales but not on earnings? What did that indicate to you about upcoming earnings that could be a catalyst for chips, particularly? I'm talking about Nvidia here, right?
Yeah, I mean, in general, like margins have been in focus. Like, are investors getting a return on the CapEx, the capital spending? And SMCI, they had negative cash flow of $635 million. And that just tells me like they can't keep up with the demand, and they have to continue to spend a lot more, and that's going to hurt their earnings. Now they have guided higher for the longer term, but I do get worried about all of these companies that are benefiting from secular trends, right? So Nvidia is part of that, and they haven't had as much of an issue keeping up with demand, but there was some flutters not so long ago about some design flaws. So I'm really anxious to see what they say. But I would say the same thing about like GLP-1 drugs, right? Like if you look at like a Lilly, they have incredible demand as well, and Novo Nordisk has, but Lilly has actually more recently seemingly kind of kept up with that demand a bit better.
How closely are you watching the election, just in terms of how that's shaping your investment strategy? And in post-November, are there moves that maybe some investors at home should be thinking or keeping in mind right now as we do lead up to November?
I mean, generally speaking, volatility often, almost every time, has gone up. I think there's only one election season that it didn't spike. So I think that is just something to keep in mind. Like, there's probably going to be ups and downs. You had a period where it seemed like Trump was almost a bygone conclusion that he was going to be the winner. And so you had small caps rallying, and you had companies that have a lot of business in China not doing well. And now that has started to unwind. I do think in the short term, it's a lot of noise, because I do think there'll end up being a split Congress. And so it will be a lot harder for any president to get anything done. The one thing I do, that is easier for a president to get done is anything around tariffs, because they don't have to ask for permission for that. And that is something that, obviously we know if Trump wins, and that is going to be a big impact. And we've looked back at, over the last time he was president and some of the companies that were negatively impacted by that. So you have to watch. You have to watch, but I think you keep investing in the things that you want to invest in longer term.
All right, Stephanie Guild, we have to leave it there. Robinhood Financial's Head of Investment Strategy. Thanks so much for joining us. Let's take a look at gold futures. They're flat right now after hitting another all-time high. UBS analysts forecasting prices could reach $2,600 an ounce by the end of the year. We're still seeing some movement to the upside here, so they're above the flat line now, just up another 0.1% here. But I think it seems, I guess UBS is one of those on maybe the more bullish side, seeing some more upside here in the longer term. But I think there is kind of this notion, and there has been this narrative on the street, that this rally that we have seen in gold maybe could potentially be poised to cool just a bit. You talk about the fact that investors are scaling back their bets right now just in terms of when the Fed is going to cut, or maybe the scale as to which the Fed is going to cut. And obviously, Maddie, that has a direct correlation here to the likelihood of some of that pricing action we'll see in gold.
Yeah, we know that gold does well amid volatility, amid uncertainty, an upcoming election, several global wars going on right now, geopolitical tensions, and then, of course, the market confusion that we've had over the past month or so with things like the carry trade unwind, and then you've got recessionary fears in the U.S. All of that creates like a bullish gold soup that can kind of come together to be good for gold. You can see those gains of nearly 4.5% over the last 3 months. So it'll be interesting to see how gold continues in terms of catalysts moving forward as we do get closer to the election, and if that is kind of a tipping point for the precious metal there. Well, coming up, we are going to be looking at the stories that are trending right now, so stick with me and Shauna after the break.
jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
General Motors is laying off more than 1,000 salaried employees globally in its software and services division following a review to streamline the unit's operations. That is according to several reports this morning. Now, the move comes as automakers are continuing efforts to reduce costs, but it does seem like there are some specifics here that are about GM in particular, because the roles are centered in software engineering. More than 600 are going to be coming from Michigan specifically, so remember to look out for that in the upcoming jobs data as we move forward here in the coming months. But we know that GM has been developing in-car software that would operate the vehicle's underlying systems. This would include things like vehicle content displays, and this is in particularly related to the company's electric models. But we've been seeing that they've kind of rapidly hired within the software development side of the company. They've pushed into EVs, and now as EV demand is starting to have question marks a little bit, it might be a sign that they got a little bit ahead of their skis there when it comes to that hiring. And the push into software has certainly been cited by several analysts as a potential headwind for the company, as they've had some software glitches and some challenges with the broader EV demand as well.
Yeah, I think many of these traditional automakers, the legacy automakers, they're right-sizing their business. They're trying to make some adjustments to better position themselves for the future. We know many of them have walked back on their EV plans, adjusting a little bit to better match up with what demand is right now, which is lower than had been initially forecasted up until this point. So again, this is just the latest here, right-sizing their business just a bit as they better position their company here for future and EV adoption here in the future. All right, let's take a look at the real estate market shakeup that took effect this past Saturday. Now, this is a top trending story on Google, on Yahoo Finance. Everyone's trying to figure out exactly what this means for home buyers and home sellers. So now home buyers must enter a contract with an agent before seeing any homes, and revamping the way commission is paid to those agents. So what this means to you, and what we have been hearing from experts here on Yahoo Finance, is that this rules is going to eventually, maybe potentially, spur some price competition within the real estate industry. It could open up the possibility to potentially save thousands of dollars, maybe if you're in the market to buy a house or if you're thinking about selling the house. But again, lots of questions about what exactly this is going to do to demand, whether or not that's going to spur demand here in the longer term, especially as rates normalize just a bit. So again, you have this taking effect as we have the 30-year mortgage rate continuing to trend lower, the expectations for the Fed to also cut rates. So this could also be a catalyst here for the housing industry moving forward.
Well, the hat that was featured in the movie Indiana Jones and the Temple of Doom was sold for about $630,000 in an auction last week. There were nearly 40 bids for the hat that was worn by Harrison Ford. So that is, a pretty penny for a hat, right? $630,000. But it's interesting, Shauna, I don't have anything to say about Indiana Jones because I don't interact with that kind of content, but it reminded me of Ken Griffin buying the dinosaur for $45 million. Mm-hmm. Obviously a very big difference in the sticker price there. But just in terms of kind of this uptick that we've seen in purchases of physical products and as a store of value moving forward here.
Certainly. All right. Well, there's lots of excitement. $630,000. That also makes you second guess maybe the consumer, or at least one segment of the consumer. Yeah. Still holding up pretty well.
There you go. All right. Well, coming up, we've got Wealth. It's dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you right here for the next hour. So stay tuned for more.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, the S&P 500 saw its best week of the year last week in a rebounding effort after August's volatile start to trading. We'll talk to a portfolio manager to help you strategize your portfolio positioning. And FAFSA. Their operations are delaying the dispersal process for students requesting aid. We'll discuss the rollout and how students can still seek and attain financial support heading into the school year. Plus, new data revealing renting a house is actually more affordable than buying one in all 50 of the U.S.'s top metros. We'll dive into when it's expected to become more affordable to buy a home again. All that and much more during today's show. But let's start with stocks. Stocks hovering near the flat line here, but higher across the board fractionally as of now. Even though we started the trading session near that flat line, we're seeing fractional gains for the Dow, the S&P 500, and the Nasdaq. Despite last week being the best week for markets this year, our next guest sees a pullback ahead. With us, let's bring in Vance Howard, who is the Howard Capital Management CEO and Portfolio Manager. Take us into your analysis here. Why are you throwing the pity party right now on this market that's trying to rebound from some of that volatility to start August?
Oh, I'm not really throwing a pity party. I'm very much bullish, but I think whenever you've had 6, 7, 8, 9 days in a row that are up, you're going to get a 3 to 4 day pullback. So I think maybe if you're a trader, you may want to look at scaling out and then looking to re-enter. As an investor, I think you're just fine. Continue to trade the trade. We saw that nasty pullback from the carry trade. That's clearly what caused that nasty sell-off, which was straight down. But net, we are bullish, even though when you look on a short-term trading basis, you may want to be a little cautious for the next 3 or 4 days because markets just don't go straight up forever.
They don't. So if we are bracing and positioning for a little bit of a pullback here from your purview, what are some tips that investors should keep in mind, should heed as they do look at their own and assess their own asset structure and diversification even, to say that, okay, I'm well positioned or maybe I'm out of position if there was a pullback?
Well, I think what's really interesting is you need to look at what's working right now. If interest rates start to drop, look at real estate investment trusts. VNQ, Vanguard's got a nice one. It's starting to break out now. And if you think about it logically, Brad, if interest rates are going to drop, which we think they are, I think everybody does, that's going to increase profitability of real estate. So, their carrying cost is less because their interest rates is less. It also greatly affects small caps. Small caps have been really sort of a bummer the past 2 years, but they're actually starting to pick up some interest in steam here. But again, they're dramatically affected by interest rates also. So I'd look at small caps, I would look at real estate investment trusts, and also your high dividend paying stocks are starting to make a move now, which is very encouraging and worthwhile to look at those quality stocks paying a good dividend.
Is there a good rule of thumb to really identify a good stock that's paying dividend versus a bad one?
I don't know if there's a really good rule of thumb. Look at the value of the company, though. You really got to go back to the fundamentals. Go back to your Warren Buffett philosophy of looking at really value play. And there's some great stocks out there. But if you don't want to spend the time looking for a great stock, look at a good ETF like DVY or VIG. Vanguard's got a good one, and iShares has a good dividend-paying ETF. And then that way you diversify your risk with one investment.
We also have, and I'll talk one single name because it's been a bellwether here for previous earnings seasons, and that's been Nvidia. You knew it was coming. It's been the AI poster child here. What can that earnings report tell us, or perhaps kind of do to the broader market activity that we have seen over the course of this earnings season, but especially given some of the rally that we've seen off of that pullback that happened early August?
Well, I think what we've seen, and you notice this, Brad, is that we saw this pullback, before the last week, we had a pretty nasty pullback, but it really brought down semiconductors. So you look at SOXX, which is the ETF of semiconductors, it really sold off hard, and it's actually an attractive buy down here for, traders and investors who want to pick up additional shares. Nvidia is the King Kong of AI right now on the chips that they're producing. So it should be a long-term hold for anybody, even with the volatility inside of the stock. It's just a wonderful company. They're printing money over there, and I don't see any way that's going to stop.
All right, Vance Howard, who is the Howard Capital Management CEO and Portfolio Manager. Vance, thanks so much for joining us here today.
Thank you, Brad.
Certainly. Vice President Kamala Harris proposing a ban on price gouging, which is when customers get charged a higher price for goods and services, especially when demand is high and supplies are limited. That's according to, dictionary.com. To discuss what this means for you and your money, we've got Yahoo Finance's Catalyst co-anchor Madison Mills here. Maddie, okay, beyond dictionary.com, let's break this down for people at home.
Yeah, I think an Investopedia might be a better place for us to start, saying that price gouging occurs when sellers increase the price of goods, services, or commodities to a level that's considered higher than what is reasonable or fair. Obviously, there can be a lot of subjective projections put onto what is reasonable or fair, but price gouging in particular is something that can occur during an emergency or a natural disaster. Of course, the pandemic comes to mind, things like hurricanes come to mind. That's because demand skyrockets at the same time as supply chain challenges that push supply down. So that is an opportunity for companies to be charging more because people will really pay whatever they need to. And that leads to the big debate about whether price gouging is even real, given that it's driven by that supply and demand. Some sources have told me that prices are simply whatever the market will bear. Nobel Prize winning economist Paul Krugman told me on our show last week that while price gouging is real, it's not the primary driver behind price increases right now.
Now, if the Harris people think that price gouging was a central factor in recent inflation, I'd be worried because I don't know very many economists who think that that's right. If they think that it's okay to single out a few examples and make some gestures, fine. So, a lot depends upon what you think this is telling you.
So it's interesting, right? The price gouging portion of Kamala Harris's economic policies is meant to tamper down on any unfair or unreasonable price increases that we are seeing at the corporate level. But there is, of course, a question about the degree to which it's unfair for companies to raise prices, given that we are seeing increased demand. Consumers have continued to be spending despite some of the data suggesting that consumers are struggling. And I think what's also interesting moving forward is whether or not just talk about policy changes on price price gouging could be enough to kind of spook companies into being a little bit more careful. But price gouging as a topic, it's very complicated. It doesn't just come from, let's say, a Walmart, for example. Walmart may say, well, actually, General Mills is price gouging in their supply of cereals to us, and we're just passing it on to the consumer. So it's a very nuanced topic, and certainly a big one and a tough one for the VP's campaign moving forward.
Yeah, we took one egg CEO to task last week, just asking why prices in eggs have soared almost 20% since last year, and it's not necessarily price gouging. Well, in the egg industry, there's also flu factors that play into that, supply side. So we at least were able to uncover deshell what's taking place with the eggs here a little bit. That was so bad.
That was beautiful.
Yeah,
I thought that was really impressive. You came up with that very quickly.
I turn a year older and the jokes get
right.
worse,
Happy birthday, Brad Smith, by the way. I'll say it. Happy birthday.
Maddie, thanks so much for joining us.
Brad.
Appreciate it. Well, the Democratic National Convention kicks off today and runs through Thursday when Vice President Kamala Harris will give her big keynote address. Harris's camp came out with an economic agenda last week intended to lower costs for American families. A committee for responsible budget, the CFRB, they estimate that the Harris plan, would increase deficits by $1.7 trillion over a decade. Here with more, we've got John Gimigliano, who is the KPMG head of Tax Legislative Services. So, John, let's dig into some of Harris's tax-specific proposals. And starting with housing, she's proposing tax incentives for builders selling to first-time home buyers and an expansion of an existing tax incentive for builders of affordable rental housing and expanding on Biden's tax credit for first-time buyers. What is your overall read on this? What do you kind of take away from how effective this could be?
Well, it's pretty obvious what the goal is here, and it really ties into what you just discussed, which is trying to find policies that are going to address the elevated prices that we're seeing across the economy. And it's pretty clear that what we saw, and this is of course not the complete Harris proposal of her tax plan, but this is an initial one, and it's really designed to try and alleviate costs in important ways. One is you talked about for home buyers. We can talk about families later, but it's pretty clear that housing is something they want to get at.
Next up here, let's go to the child tax credit. Vice President Harris proposing the restoration of a $3,600 per child credit and $6,000 for families with children under the age of 1 here. And so this seems like really looking at the family expansion among millennials and even Gen Zers and trying to best anticipate where there could be some help. How much help would this actually put into the system?
Well, these are very meaningful tax incentives. This $3,600 expansion of the child tax credit, we've seen that before. That was first enacted in the COVID era policy, one of the first pieces of legislation that the Biden administration did. And it was a very significant amount of money for families. And then layering on top of that, $6,000 for children in their first year of life. Very much, I think, a pro-family policy. And it's an interesting strategy to sort of triangulate around where the Trump campaign has been on some of their pro-family policies. But these would be substantial increases of current law.
And then while we have you here, Harris also backing President Biden's pledge that no one making under $400,000 a year will pay more in new taxes. This is not new, we should note, as this was something that President Biden himself campaigned on in 2020 as well. I mean, is this expected to move the needle at all in terms of the difference between what families are already expecting in their taxes and what they can expect going forward?
Yeah, I'm glad you mentioned this because this is really the stealth part of the Harris plan that we saw last week. Because simply by making that commitment, we will not raise taxes on those making $400,000 and less. That more or less is an endorsement of some of the Trump tax plan that was enacted back in 2017. $4 trillion of tax increases are scheduled to occur next year if Congress does nothing. And if the Vice President Harris's position is that we're not going to allow any tax increases on anybody making $400,000 or less, that's another couple $2 trillion tax commitment to extend some of those 2017 era policies. And that's an important one that maybe flew under the radar a little bit, but was very meaningful to me.
And then just as you were kind of doing a moment ago, and you're comparing and contrasting of what we've heard on the economic plans, at least as it pertains to taxes, where do you see kind of the candidates kind of stacking up, and where is one plan perhaps pulling ahead, or would you like to see more?
Well, I think both campaigns are committed to, we're now sure, extending some or all of those $4 trillion of tax provisions that expire at the end of next year. The big question, of course, is how are they going to pay for this, right? And this is something that, if you're a business, right, you should be concerned about. Most of those provisions are applying to individuals. And there's a real risk that as either a Harris administration or Trump administration, who knows what kind of future Congress will have, seek to pay for those, we're going to be looking at the possibility of higher taxes on businesses as an offset. That's a real risk that many of my companies, especially multinationals, are trying to gauge as they go into next year.
Yeah, it certainly will come down to Congress as well. Some of the down ballot voting that people should be right to keep in mind also. John, thank you so much for taking the time here with us today. KPMG, John Gimigliano, I should say, KPMG, Head of Tax Legislative Services. Appreciate the time, John.
Thank you, Brad.
Thank you. Hey, everyone, right after the break, we're breaking down how a budgeting strategy might be able to change the course of your financial future. Stick with us. Over 77% of Americans have some sort of debt, according to the Federal Reserve. And the best way to get rid of that debt, pay it. Straightforward, right? Well, our next guest got herself out of over $70,000 worth of debt using some simple budgeting strategies. To discuss, let's bring in Bernadette Joy, who is the Crush Your Money Goals author and money coach. Bernadette, great to have you here with us. All right, so you were so successful at this that we got to share some of these tips with our viewers as well. And there's something that you have that you call the 3-bucket method. Break this down for us.
Sure. So a lot of budgets feel very complicated. And honestly, a lot of people fall off of budgeting because it gets boring and really mundane. And so I just put down my budget into 3 major categories. It's strive, revive, and survive. And survive is half of your budget. I suggest that people try to aim for no more than half of their budget going to their necessities, and then splitting the other half of your budget between things that you want, revive, so the happy things, the things that you enjoy spending money on, and then the other quarter of your budget that's focused around paying off your debt and managing your savings.
Wow. Okay. And so for people right now that might be watching and say, hey, you know, that boat that Bernadette was in with that $70,000 in debt, that sounds quite similar to what I might be going through. What was your thought process? How did your mentality have to change?
Yeah, so it was actually $72,000 of student loans. And I know a lot of people are feeling that pinch right now. And my thought process was pretty simple. It was, I don't want to live in this debt forever. I want this debt to be a short-term solution for me, which was to go back to school and get a degree. And I don't want it to be a long-term lifestyle. And I think right now, a lot of people just are accepting the fact that debt would be a long-term lifestyle for them. And instead, I really want people to think, hey, I'm in debt right now, but this is not forever.
How can people make the choice about what debt to take on, good debt versus bad debt?
So I actually don't believe in good versus bad debt. I think all debt is debt, and characterizing it more around how it makes you feel. So the simplest way that I tell people to focus on paying down debt is around the debt snowball. I particularly am a big fan of it. I had a psychology degree. I also found that it worked for me personally and for many of my clients, where instead of trying to do all of the math and trying to say, okay, well, you know, I'm going to math my way out of this. Truthfully, if you're going to math our way out of it, then we wouldn't have been in debt in the first place a lot of times. So I suggest people to try the debt snowball, which is really just to focus on your lowest balances first. Even if it's 0% interest, even if there's other things that are higher interest, what I found that works really great for a lot of my clients is that it starts to build that momentum. It starts to build that confidence that, hey, I can do this. I'm capable. I'm smart. And also it's just less things to have to worry about later on.
You know, it's really interesting. You were mentioning that much of that debt that you carried was from your collegiate experience, from university. And so there are a lot of students that are either just getting started, might be midway through their higher education, and trying to make sure that they're not amassing debt over that time. What is the perhaps smart money habit that they can put into effect right now that's going to help them for when they're ready to, you know, walk across the stage and effectively be able to apply that skill that they've picked up along the way?
Yes, I actually just wrote an article about this for kind of new grads and first-time professionals, and it's to practice budgeting now. So while you still have the time and while you still have, you know, some of the things that you can control within your expenses, is to get in the habit of budgeting now, even if you don't have a lot of money coming in. And specifically, once you graduate, again, I focus people on trying to get their necessities under 50% of their total income, even if that means you're going to have to make some short-term sacrifices, knowing that will pay off in the long run. All
right, just lastly here, let's talk about something fun. Financial freedom. How did you know when you were truly financially free?
You know what I will say is, for me personally, so I'm 39 years old. I have enough money now to retire at 40 next year. And the moment that I felt financially free was when I started looking at that budget and I didn't feel anxious about it anymore. And I know budgeting can be really stressful for a lot of people. And the reason that people avoid doing budgeting is because when you look at it, it makes you feel bad. But there came a point where I started looking at my budget, and it was a couple of years ago, where I was just like, I actually look forward to doing my budget. I actually have money that I can spend that I don't have to feel guilty about.
All right. Look, well, if you can retire next year, Bernadette, hopefully we can continue talking to you, but enjoy that retirement. Why not? Bernadette Joy, Crush Your Money Goals author and money coach. Thanks so much for taking the time.
Thanks so much for having me.
Absolutely. Let's switch gears here. School is almost back in session. And as incoming high school seniors expect to spend this fall applying to colleges and filing and filling out their FAFSA, they should know the issues with the Financial Aid Office. They are far from over, unfortunately. Here with the latest on FAFSA issues, we've got Jennifer Finetti, who is the Director of Student Advocacy over at Scholarship OWL. Great to have you here with us. What's going on with FAFSA right now?
You know what? There's so much going on with FAFSA. This whole year has been really challenging.
The latest information is that financial aid officers cannot submit corrections to the FAFSA in batches on behalf of students. So what this means is they need to submit these changes one by one for anyone that needs FAFSA corrections. And this year in particular, there are lots and lots of corrections to be submitted. So what this means is that money will not be dispersed as soon as it usually is. So again, students are sort of on the hook and having to wait for that financial aid to come through, unfortunately.
Is this impacting students being able to begin their curriculum, begin their coursework, if they're not able to get what they were expected to be dispersed by now in order to make the first tuition payment, perhaps?
For most students, colleges are willing to wait for that money. Colleges that are, certainly the vast majority of colleges are going to be saying to students, hey, it's okay, go ahead and enroll in classes. And when the money comes in, then we'll take care of your tuition with that money. However, the smaller colleges may not be able to do that holdover a little bit longer. It's been difficult for small colleges anyway, but this may add further pressure to them.
What about for students who might be seniors in high school right now and they're trying to figure out not just what school they want to go to, but how much they're going to need in aid as well on the other side of that to pay for tuition, to pay for the college experience? What does this all entail for them?
Well, next year's FAFSA, unfortunately, is going to be delayed as well. They just announced this, that it's going to be delayed as well. So, what I tell students, what I've been telling them all year, and what I'm telling high school seniors is try not to focus on FAFSA so much. Yes, submit the FAFSA when it's available to you, but focus on other ways that you can take more control of your financial future. So that means focusing on applying for scholarships year round, aiming for 3 scholarships per week. And on top of that, of course, all students who are 16 and older should be working part-time during the school year, full-time during the summer. There are lots of ways that you could bring in money, and federal financial aid is only one aspect. And for many students, they wouldn't qualify for federal grants anyway due to family income. So, focus on things you can control right now.
It's so interesting. We always talk about the average number of streaming subscriptions a household might have. What's the average number of scholarships that students are applying for and need to have in order to offset the costs of college now that we've seen tuition really be rising and outpacing wages even over decades at this juncture?
Well, you know what? Scholarship dollar amounts vary. Many scholarships are for $500 or $1,000 or $1,500. There are some scholarships that have higher value, but so it's very difficult to say how many scholarships you need to have. The focus should be on how many applications you can submit and focusing on scholarships that are really a good match for you, that are really relevant to you, that you're passionate about. You're more likely to be successful with those scholarships versus having a more scattershot approach. And then as far as how much you need, that also depends on what the college cost, what the college retail cost is for you. So I tell students to focus on lower cost, affordable colleges. Some of those really elite colleges may have high endowments. They may offer large scholarships, but even if you get a large scholarship, their price tag is much higher to start with. A great place to start is community college. Community college, you can go there for free in some states or for very low cost in others, and you can complete 2 years of your 4-year education there. And during that time, you can be working, saving money, applying to more scholarships, so you're going to be more able to afford your degree overall.
Just lastly, while we have you here, Jennifer, we were talking about some of the different tax policies from Vice President Harris that have been proposed for and discussed, which we'll hear much more during this week's DNC. To what extent have students heard what they need to? What more needs to come forward to really ensure that the cost of college can continue to come down, or at least stabilize and hopefully over the long term start to come down?
It's very difficult to say what students are going to get because even under the Biden administration, there was so much that was focused on in terms of student debt forgiveness. Student debt has been forgiven in pockets to specific situational things for students, like if they were defrauded by their college, if they're disabled. But for the vast majority of students, loan forgiveness simply hasn't been there. I know that's still a focus that students and recent grads have, but that may not be something that's palatable to Congress or to the Supreme Court. So, again, I focus on what students can control rather than looking at what's happening politically in those areas, because anything that's debatable will be sent to the Supreme Court where decisions are going to be made. So, focus on an affordable path to college for yourself. And if you can avoid taking on debt to begin with, then it won't have to be forgiven later on.
Our director of the Scholarship Out Director of Student Advocacy, Jennifer, thanks so much. Appreciate the conversation, and thanks for a second while I grabbed your title here in my myriad of papers that I carry around with me during every show. Thanks so much. Coming up, everyone, is it really better to rent than buy a home? Well, this may be true in several cities. I talked to an expert about just that after the break. A new report from Realtor.com shows it's more affordable to rent a home than buy one in all 50 of the top U.S. metros. This has grown from last year, where 47 metros were cheaper to rent than buy. Here with more insights, we've got Ralph McLaughlin, who is the senior economist at Realtor.com. Ralph, great to have you on here with us. First and foremost, I mean, these were some pretty interesting results that you saw come across. And look, I've lived in many of these cities, a few of them at least, over my rental past and history, where I knew I couldn't be able to buy a home. But take us into some of the biggest surprises from your findings for you.
Yeah, I mean, I think some of the biggest findings from this report is that this is now the 12th month that we've seen rents actually decrease on a year-over-year basis. So that's certainly contributing to the fact that it is cheaper to rent than buy in the 50 markets that we track. Some other interesting findings that we've seen are that the gap is biggest in very expensive places on the West Coast and in Texas. So Austin, Seattle, and Los Angeles have the biggest gap. In those places, it's basically a no-brainer whether or not you should rent or buy, at least from a cash flow perspective. Those places, it is much cheaper to rent than to buy. We have also seen rents start to come down on a year-over-year basis. Again, 12 months, they're down by not just 1% overall, but we're seeing rents of one-bedroom units come down by almost 1.5%. Now, we are starting to see some markets shift towards buying. They're still cheaper to rent than to buy, but markets like Birmingham and New York have seen listing prices actually rise on a year-over-year basis. And so while it's still cheaper to rent and buy in those markets, that gap is also narrowing somewhat.
Okay, and so, I mean, is this net positive or net negative? I mean, we're talking about rental prices coming down, which is good, but we also want to see home prices come down too, so that it's more affordable for people who are currently renting to make the transition and do so seamlessly at some juncture.
Well, for renters who want to buy eventually, there are starting to be positive or net positive signs here that maybe in the next 6 to 12 months, the market will be much friendlier to do so. So like I mentioned, we've seen prices start to come down a little bit. We've seen rents come down, so that's favorable. And the big kicker over the next 6 to 12 months is how much mortgage rates are going to come back down. Mortgage rates just a few months ago were over 7%. They're now down to around 6.4, 6.5%. And if the trajectory is as forecasted, we could see rates as low as 6%. And certainly that is likely to kick some markets back into the better to buy than to rent range. Although what happens with prices and rents in the interim over that period really are going to help dictate how things play out.
You know, I guess as you overlay additional data about where homes are being built, is there any kind of sense that you get around where more capacity is coming online in new home construction that's taking place, and looking across these markets and trying to figure out where we can anticipate even more movement, even more of a delta, whether that be a tightening of the rental rate and what people are paying on the mortgage front, or even a widening of the gap?
Yeah, so I think we'll see tightening of the gap in places like the South that builds a lot of homes. So places like Texas and Florida, where they do build a lot of homes, we've seen more inventory come onto the market, which has led to homes, leaving the market slower. And in addition, in those places, we've also seen a rise in more affordable inventory on the buy side, below $350,000. So in those markets where rents have not grown a lot, we are starting to see prices or signs that prices might come down even more than they already have. And that would actually help narrow that gap, which means that if mortgage rates fall by another 50 to 100 basis points over the next 6 to 12 months, it almost certainly will make buying a little bit better of a deal than renting. Despite the fact that now all 50 markets are in favor of renting, we could see that shift really start to play out here in the South over the next 6 to 12 months.
Ralph, also just lastly, while we have you here, I want to get your reaction to what we're seeing right now playing in the political landscape, and specifically as both campaigns are going to try and figure out how they can incentivize, or at least how they can get their message to first-time and new home buyers out there. I mean, one of the most recent moves coming from Vice President Harris's camp, the Democratic nominee, for thousands of dollars that could potentially be used for first-time home buyers to put towards that home as well. I wonder just what you're making of these moves.
Sure. I mean, one of my favorite topics, at least now, to talk about. So let's dive into it. The Harris administration has announced that certain home buyers, first-time home buyers, would be eligible for up to $25,000 towards a down payment. And that's a non-trivial amount towards a down payment. If you look at the median price home in the U.S., that would account for 5% of the down payment needed. on the medium priced home. Some households, if their income is high enough, that would pay for their entire down payment. They could put 5% down, use that $25,000 for that 5%, and not have to come up with any of their own money to put in. But I think more exciting than that, I mean, who's going to say no to free money towards a home? As an economist, I'm more excited about policies actually on both sides of the political aisle, and that is policies focused on supply. Both the Harris administration and the Trump campaign have announced policies targeted towards building more housing. And that is one of the real problems we've had in the housing market, not just over the last 5 years, but over the last 2 to 3 decades, which is we've been underbuilding compared to how much we've built, in the 60s, 70s, and 80s. On the Harris side, they have focused primarily on removing barriers to construction and also encouraging policies that help speed up construction so that supply response will be there as demand rises. And then on the other side of the aisle, the Trump campaign has said they want to double down on the American dream and encourage growth in the suburbs. So even though there are two slightly different flavors on a bigger theme, which is new supply, it is very, very comforting, welcoming news for an economist like myself who's been studying housing for a couple decades and has seen that, the real issue has been on the supply side. So at least, as a housing economist, this has been, one of my favorite, election years because that focus has been on supply and not as much on demand.
Ralph, while you've got that economist hat on, just lastly here, as you're thinking about the Fed and their policy pathway to cut rates here, what is your greatest anticipation for how that's going to impact the housing market?
Yeah, so we're going to expect a 25 basis point cut in September, and then 25 to 50 basis points by the end of the year. Certainly, some of that expectations have been priced in to mortgage rates already. We see mortgage rates come down quite a bit over the last month. We do anticipate as we get better readings on inflation and perhaps better readings on the job market and unemployment, that we will see those start to come down in a very steady pace. So we're forecasting mortgage rates at the end of the year to be down around 6.3%, maybe slightly lower. And that's certainly going to help buyers as mortgage rates come down. But we've seen inventory rise as well. And rising inventory not only gives house hunters more choice that they haven't had, but the lower mortgage rates is going to make it slightly more affordable to buy that house.
Ralph, thank you so much for taking the time here. Ralph McLaughlin, who is the senior economist at Realtor.com. Great to speak with you. Love to have you back.
You too. Take care.
Thank you. Well, homes just keep getting more expensive. A $1 million price tag on a home may no longer mean luxury. Redfin reported a record number of homes are now valued at $1 million. Yahoo Finance's Danny Romero has the details. Danny, we were just talking about hopefully home prices coming down, but as of right now, the status quo is more homes than ever sitting at $1 million. What do we know?
This is good news for homeowners, but essentially bad news for potential home buyers. Redfin reported that 1 in 10 U.S. homes are worth $1 million or more, and that's thanks to home prices reaching a record high. The median home price is up 4% on a yearly basis in June, and it's also important to note that home price growth has eased this year, but prices are still rising on a yearly basis. Now, this also heightens the affordability issue, and another part of the equation here is housing supply. Inventory has been rising. However, it's 30% below pre-pandemic levels because homeowners are locked in to that lower rate during what they got during the pandemic. Now, regionally, California has the biggest share of $1 million homes, and part of that is due to the tech industry. Both San Francisco and San Jose, about 80% of homes are worth 7 figures. Now, there are still a handful of homes and towns that are affordable. For example, Detroit, Cleveland, Pittsburgh, and Kansas City, Missouri.
So, given the recent data, what does this mean for home ownership?
Brad, people are delaying home ownership. The median age of home buyers right now is 35 years old. That's what Zillow reported. And there's a lot of people that do want to buy a home, but the affordability challenges are limiting them. And there is expectation that the Fed will cut rates next month, which could put some more downward pressure on mortgage rates and could also put some downward pressure on housing costs, Brad.
All right, Danny, thank you so much breaking down this data, the latest out of Redfin here. and covering the entire housing market. Appreciate it, Danny. Coming up, everyone, is America in a retirement crisis? Perception may not always be reality. We're going to explore when we return. Is America in a retirement crisis? Big question. Well, according to a recent survey, Americans certainly believe they are, with almost 60% of respondents either somewhat or strongly agreeing. But is perception actually the reality of the situation? Here to explain it, we've got David Blanchett, who is the PGIM DC Solutions Head of Retirement Research. David, thanks so much for taking the time, joining the program here with us. And you have data from a recent survey that you guys have been able to run on this as well here. What were some of the findings here that you were able to take away about perception versus reality?
Sure. I think that there's a growing perception among Americans that we are in a retirement crisis. And that's coming from different places, but we see it in a variety of surveys, in our surveys, other surveys asking Americans how much they have to save to retire successfully. So to me, what it just says is there's lots of fear out there today among people of all ages about the ability to retire successfully.
So how is the number? Because there used to be like one general number that we would toss around, like, hey, if you have this much, you should be set. But I mean, it changes, of course, for everyone, depending upon their situation. So perhaps, I don't know, a rule of thumb should be a percentage base. What is that good rule of thumb that you at PGIM are discussing with some of your clients?
Well, you know, there are these clever commercials a decade ago where everyone had a number that was, you know, walking around over their head. They could see their number. And in reality, everyone's number is a bit different. I think that like the best way to think about how much you need in retirement is to think about, you know, if you make $100,000 a year, you spend, let's say, you know, $60,000 a year, you're going to get $40,000 a year from Social Security and a pension. It's that gap. It's that $20,000 gap times, say, 20. And so that, you know, then you need, you know, $400,000 a year or some multiple of what's not covered through pensions. The problem with this idea of a single number, you need $1 million saved for retirement, is that it's really very personal in terms of what you got in terms of existing sources of guaranteed income, as well as what you kind of need to have in terms of spending in retirement. So it's very, very personalized, but a good bogey is about 20 times your unfunded target from your existing pension income sources.
When we look at some of the data, it was interesting. Of the 30% who strongly agreed that their retirement situation was a crisis, 87% also believed there was a national crisis here. So what is kind of really taking place here? Is there a national retirement crisis? Yes or no? And how do we kind of address what people's perceptions are?
So I'm in the strong no camp. I think that a problem is the word crisis means different things to different people. Some might suggest that if one American is not in great shape, that constitutes a crisis. If you look at polls of retirees, indicators of overall economic well-being, retirees are actually doing pretty well. We have a pretty robust pension system, Social Security. So I don't think we have a crisis. Now, there are things we can do to improve this situation, but I don't think that it's a crisis.
David, where are some of the other opportunities here that you're sensing that people who are approaching or near retirement are kind of looking across here? And I ask this because you see a market pullback like we saw at the beginning of August. And naturally, those who are close to retirement are saying, wait, that puts now a dent in some of the equities that I might have been holding and waiting to cash in on. So, how are you talking to people about diversifying their assets that they can draw upon on any time, regardless of the market, and preparing themselves for retirement, regardless of what equities do?
So I think it's important to be invested in a professionally managed, diversified portfolio. If you participate in a 401k plan, that would be a target date fund. I think beyond that, it's really savings rates that are going to drive the outcome for your retirement. So save at least 15% if you can or more, and as you age, try to save as much as possible. So it's really going to be, I think, savings that drive retirement outcomes, less so the markets, as long as you're investing in a diversified, professionally managed portfolio.
All right, David Blanchett, who is the PGIM DC Solutions Head of Retirement Research. David, great to speak with you. Thanks so much for taking some time.
Good thing.
Coming up, everyone, could the popularity of weight loss drugs like Ozempic be causing your and my healthcare insurance premiums to rise? We'll have more on that when we come back. You know them, you might love them. GLP weight loss drugs like Ozempic could be causing a spike, though, in your health insurance costs. Our very own Anjali Kamlani has been looking into this and has the story. Are we okay? Are we cool?
Well, we don't know yet, but definitely looking at an increase in prices for sure. And we knew that that was being predicted as a side effect of the GLP-1s being covered by employers as well as large insurance companies. But we also know that there has been a limitation on who is covering what. Most employers and large insurers are covering for diabetes, as is the large government payer Medicare, but some have not necessarily covered it for weight loss. Still, we've seen reports that show that the cost of weight loss drug spending is fourth for employers, and that's according to Icahn, as well as a specific spike of 15.6% for GLP-1 utilizers of diabetes and 78% increase of use for weight loss. So that just tells you how much. Now, what you see on your screen is a prediction of what the insurance cost increase is going to be like. 2023 and 2024, we saw about 6.4% increase, and 2025, that is going to jump to 9%. And we know that every time the costs jump, we get to share more of that burden with the premiums, with the out-of-pocket. So expect that to be changing in your insurance next year. Now, what that means for each individual employer, of course, depends on whether or not they're covering it for weight loss or just for diabetes, but that still increases the pool, the risk pool costs. And so that is the reason why we are going to be seeing that increase in impact. We know that the drugs have been within the 100, about 1,000 to 1,300 in terms of cost per month. So that has been the reason why, if you add that up over a year, what that cost looks like. We do know that because Lilly's cost for Zepbound kind of brought down the market competition a little bit, they're seeing a little bit of change in those prices, but not enough to stave off that increase.
Yeah, really remarkable. The list prices versus what people would actually be paying, but their healthcare insurers, and as we've talked about in the past, that is therein lies the problem, actually.
Subject to availability and I don't know.
And coverage, I guess, to a certain extent. Angelique, thanks so much. Appreciate it. Angelique Emlani joining us here. Let's do a final check of the markets, everyone, as we're taking a look at the major averages. We've got those across the bottom of your screen and blown up in big on the trifecta board here as we're up across the screen. We've got the Dow, the S&P 500, and the Nasdaq all up by about 0.4%. Had to catch myself there for a second, but it is indeed all 0.4%. We'll be generous and round that off to there. And that's it for Wealth, everyone. I'm Brad Smith. Thank you for watching here on this Monday, but stay tuned. We've got more Market Domination with Julie Hyman and Josh Lipton. They're reunited and it feels so good coming up at 3 p.m. Eastern Time. You don't want to miss it.